In the last session, we were seeing about what is the meaning of insurance and what were the functions of insurance. In this session, we will be seeing what are the basic principles when we are going for insurance, what are the basic principles to be considered, or the rules of actions of insurance. Now, in this session, we are going to learn about the general principles of insurance. There are 7 principles which we have to learn, and it is on basis of these principles the insurance policy is being handled. So, we are starting with the session principles of insurance. Now, the first principle of insurance what we have to study is about utmost good faith. Utmost good faith. Utmost good faith. This principle is based on a contract of abremia fide. It's a Latin term. Abremia fide, which means good faith. That means both the parties means insurer and insured. Both the parties must show good faith to each other. Both the parties in the insurance contract must show good faith to each other. That means insured must show good faith to insured and insured must show good faith to insurer. How insured has to show good faith? Insured has to disclose all the known aspects about the subject matter. What is the meaning of subject matter? Subject matter is the thing which we have insured for. It can be a car, it can be a house, it can be even life. So, insured must show good faith to insurer by disclosing all the known facts about the subject matter to the insurer. Now, how insurer has to? Insurer must make clear all the terms and conditions. Insurer must make clear all the terms and conditions regarding the contract to the insured. No hidden conditions must be there. So, both are to show good faith among each other. Both insurer and insured must show good faith among each other. That is the contract, that is the principle of utmost good faith. That is the first principle. Second principle is the principle of insurable interest. Principle of insurable interest. Insurable interest. Principle of insurable interest is talking about a pecuniary interest. Pecuniary interest, which must be there for insured regarding the subject matter. A pecuniary interest must be there, a special interest must be there, and it has to be there at the happening of event. So, there must be a pecuniary interest for the insured in the subject matter, and this must be there at the happening of loss. Then only he will try to protect it. If only there is a special interest, he will insure it and he will try to protect it. If some losses, possible loss is going to happen, he will take measures. So, that interest is which is being considered by the insurance company. So, there must be a pecuniary interest for the insured in the subject matter, and that is called insurable interest. It is out of that interest insured is insuring that subject matter. So, that insurable interest, that pecuniary interest must be there for the insured in the subject matter. That is the second principle. Third principle is the principle of indemnity. Indemnity. What is the principle of indemnity? We have already understood what is the basic aim of taking an insurance. It is to make good the loss. So, indemnity basically is talking about making good the loss. Making good the loss. That means it is to bring back insured to the position before happening of loss. That is what is meant by making good the loss. Making good the loss, that means bringing back insured to the same position before the happening of loss. So, indemnity principle is talking about such a condition where insurer has to take necessary measures to bring back the insured to the same position before the happening of event, and that is what is called as making good the loss, bringing back the person in the same condition before happening of loss. But you have to, there is an exemption for this principle in case of life insurance. Life insurance, life of a human person can never be valued. So, it cannot be brought back in the same position before the happening of loss, because if human life is lost, by no amount we can compensate that. So, in life insurance, indemnity principle will not fully happen or fully cannot be applied. Indemnity principle is bringing back the insured in the same position before the happening of event. Human life cannot be measured in terms of money. Because of that reason, indemnity principle is not fully acceptable, fully applicable in the case of indemnity principle. Indemnity principle will not be applicable in case of life insurance. In case of life insurance, indemnity principle is not applicable. So, indemnity principle, that is the third principle. Now, coming on to the fourth principle, it is the principle of proximate cause. Proximate cause. Proximate cause. Proximate cause simply means nearest cause. Nearest cause. Nearest cause. Proximate cause means nearest cause. That means when a loss is happening, the most dominant, the most efficient, the most nearest cause is to be considered, and a cause is to be compensated only for the perils, which are stated in the policy. And because of this, the nearest cause is to be considered. For example, if an insurance is taken for, if there are two causes, if two causes are there for happening of a loss, the most important cause, if it is stated in the policy, need to be considered. If it is because of fire, a ship drowned, it has to be considered. The main cause has to be considered is of fire. If ship is drowning, that is a loss. Having fire in the ship, that's another loss. Two are different things. So, according to what is stated, it is to be considered. It is to be considered. It is perils happening in the sea. Marine insurance, we have to learn. That's why I am not using the terminologies. If it is a peril happening in sea, but if it is because of fire, it is something different. So, which is the dominant cause, as according to what is stated in the policy, that has to be considered. The nearest cause has to be considered in considering for compensating the loss. So, proximate cause, it is also called as causa proxima. Causa proxima, which means nearest cause, the most dominant cause, most effective cause has to be considered when there are number of causes. So, that is another principle. Now, going on to the fifth principle. Fifth principle is the principle of subrogation. Subrogation, principle of subrogation. Subrogation simply says that it is a right of insurer to stand in shoes of insured. Right of insurer to stand in the place of insured, stand in the shoes of insured, which means once compensation is given for a subject matter, ownership of that will be shifted to the insurer. Once a claim is being settled, the ownership of the property will move on to the insurer. That means insurer will take place of insured. Once the settlement is being made, insurer will step into the shoe of insured. That means the ownership of the compensated property will pass on to the insurer. A car is being given on full insurance and a new car is given. The old car ownership will pass on to the insurer, because in insurance, insured is not permitted to make any profit. That is why the ownership of property compensated will pass on to the insurer. So, that is what is called subrogation. Insurers standing in the shoes of insured. That is another principle. Now, coming on to sixth principle, principle of contribution. Principle of contribution. This comes in case where the same subject matter is insured with two insurance companies. When two insurance companies. Now, when same subject matter is insured with two insurers and if loss happens, both the insurers contribute in proportion only for actual loss. Means when same subject matter is being insured with two different companies, say a subject matter is of worth 1 crore. It is insured with one company for 75 lakh and another company for 75 lakh, and if a loss happened to that subject matter, you cannot expect both the companies together give 1 crore 50,000 for the subject matter. Both the companies will come together, they will contribute in a proportion only for 1 crore. 150 crore, it will be compensated only for 1 crore. So, they will be contributing only for the actual loss, So, both the companies will come together and they will contribute only for the actual loss what is happening. So, that is the principle of contribution, because in insurance, no insured is allowed to make profit. Insurance is not a contract for making profit. It is for compensating the loss happening. And going on to the last one, seventh one is the principle of mitigation. Mitigation. What is the principle of mitigation? Mitigation principle is saying is that insured is it is the duty of insured to take necessary measures to bring down the effect of loss. Bring down the effect of loss. An insured is expected to take necessary measures to bring down the loss, to reasonable steps to minimize the loss happening to the subject matter. An insured is expected to take reasonable steps or necessary steps to bring down the loss happening to the subject matter, insured property. So, that is a very important thing. If a subject matter which he has insured or she has insured is caught with fire, the insured is expected at least to pour some water to put off the fire. Not just watching and seeing it and thinking that let it burn, insurance company will compensate me. No, that is not what is expected. Insured is to take reasonable steps to bring down the loss which is happening to the subject matter. That is what is said in the principle of mitigation. So, we have seen 7 principles of insurance. It is on the basis of these principles an insurance contract is working. So, it is the rule of actions. These are the rules of actions in insurance. So, that is all.